Hey, welcome to another episode of Financial Theory. Let's talk today about buying your first property here in Australia. If you're not aware of what to do, sometimes it can cost you a lot of money and it could be a massive trap as well. Now, I've actually been in the real estate game for nearly 20 years now, and I've made a lot of money from real estate. The majority of my net worth is from real estate. Just going to give you some crucial tips to actually help you when you're actually buying your first property here in Australia. Tip number one is never borrow to your maximum capacity. Why? This is extremely risky. Now, if you over leverage yourself and you borrow to your maximum capacity, let's say interest rates just randomly spike up, interest rates go up 2 or 3 times within the next few months, what are you going to do? You most likely are going to lose your house. Do not borrow to your maximum capacity. I would suggest borrowing 50 to 70% of your maximum borrowing capacity because it's extremely risky. If anything goes wrong, you're going to lose your property. So you want to leave a little buffer just in case if something goes wrong. Tip number two is to buy a property in a good location with strong demand. So what do I mean by a good quality location? A location is good and has high quality if, say, for example, it has a low crime rate, for example, it has shops nearby, it has schools nearby, it has gyms nearby, it has transport nearby. A good location essentially has all the necessities that a family would actually need to actually live in that area. And also for me personally, I like to purchase a property that's not too loud, away from factories, away from airports, away from noisy roads and highways, those sort of places. I would not buy near those sort of places. So I usually like to buy in a smaller street in a nice neighborhood. And for me, when I buy properties, it's always for renting out. Like I can actually never live in those properties. I just buy the property and I never see the property again, essentially. So that's what I would do. Look for schools nearby, look for transport nearby. So you just have to pick a good location with all the necessities for a modern family to actually live in. And you got to check the demand for the location as well. Check in that suburb, like how many houses are going to be built in that area, what's the vacancy rate, so that you can have a certain gauge of what the demand is in that suburb. Right, tip number three is to think long term, because buying and selling a property is extremely expensive. So to truly make a fat profit, you want to be keeping the property for 7 to 10 years plus. Whenever I buy an asset, I never sell. I never sell. I buy property, I keep it until I'm dead. Like I have no interest in selling because every year the house appreciates. Every year it's making me money through rental payments. When you sell, you have to pay taxes to the government. You've lost a massive chunk of your money. The property appreciates massively every single year. It's giving me cash flow every single year in terms of rental payments. Why would I sell? That's insane. But that's just me because I'm a very long-term thinker. I think 10, 20, 30 years. I never think short-term, never. And there's also a lot of other costs when you actually sell your property as well. So you need to keep the property for at least 7 to 10 years. Tip number four is to have a strong deposit. A lot of people have a very small deposit, and what that means is, yeah, you may be able to get a grant from the government or something like that to actually get a loan from the bank, but you're going to have to pay insane amount of interest and the repayments are going to be absolutely massive. So my suggestion is, if the more you have for your deposit, the easier the repayments are going to be. So you got to think of it that way. If you don't have enough money for a deposit, what I would suggest is consider trying to boost your income and try to minimize your spending as well if you're trying to save. So you can try things like asking for extra time, working more hours, finding another job, finding a higher paying job, or finding a side hustle or creating a business or something like that that can actually help increase your income. And also at the same time, try to cut down on your spending as well. That's really important as well. Avoid eating out all the time. Avoid spending money on depreciating things like cars, car loans, credit cards. If you don't have enough of a deposit, those are things that you can actually try to actually help boost your income and also reduce your spending. Tip number five is to keep an emergency fund after the settlement. A very common mistake that a lot of first home buyers do is they spend every dollar that they've got on the deposit and they've got literally nothing left. If anything goes wrong after the settlement, you're in serious trouble. You have to consider that. So I would suggest keeping 10, 20 grand on on the side just in case of some sort of emergency. Say if you have unexpected fees or expenses, you can actually cover that. If you spend every single dollar that you have on the deposit and you have literally nothing left, you're extremely vulnerable. So you got to keep that in mind. So tip number 6 is to get a building inspection. This is really important. You got to check for things like pests and in terms of the building infrastructure to make sure that the house is not falling apart or it's not infested with termites and things like that. So the last thing you would want is to purchase a property and then realize that the house is infested with termites and it's gonna tear down your house. So it's really important to get a building inspection before purchasing the property. Very important. Tip number 7 is to understand there are a lot of costs when you're actually buying a property. So it's actually more than you probably expect. There's things like stamp duty, transfer registration fees, conveyancing legal fees, loan application establishment fees, lender's mortgage insurance, building pest inspections, home insurance, moving and connection fees, council water rates, strata, body corporate fees, maintenance budget. So just realize that there are a ton of additional fees. So you just have to be aware of that. Otherwise, it's just going to freak you out when you actually see how many additional fees that you have to pay. So tip number 8 is to check for fire and flood and insurance risks. Do a double check to make sure that the area around the house is not prone to natural disasters like bushfires or flooding. Double check those things because it's really, really important. The last thing you want is to buy a property and realize that the area is prone to natural disasters. Tip number 9 is to focus on land value and scarcity. Keep in mind that land appreciates and the house itself depreciates over time. So that just means that if the demand is high but there's not enough resources to actually recreate your property, that's when your property value will actually go up. So for example, if there's no more land in the CBD area, then of course your property is going to go up, right? Because there's no more room to build any more houses. So your property is a very limited resource. So that means that your property is going to go up. So you got to consider those sort of things before buying a property. For me personally, I like to buy houses. I don't like to buy apartments for me personally. The reason is because a house is very unique. A house is really one of a kind, right? Let's say if you got a buyer or someone that likes the property, they'll come in there and they like your house. Then they want to rent it or they want to buy it. And it's very unique because no one else is going to have that exact house. They don't need your apartment. There's like a million other units exactly the same. So I would rather buy a unique house because it's very unique and there's no other houses that are exactly like the house I purchased. If there are heaps of other properties exactly like your property, then it's not going to be worth as much. Right? Tip number 10 is to research future housing supply and zoning. And why this is actually important is because let's say you buy a house now, but in the future, let's say they start building a whole ton of houses within that area, then your property is most likely going to go down in value because there's going to be more supply, right? It all comes down to demand and supply. So if there's more supply within your area, then your property is actually going to go down. So if there's a large future supply, that can actually dilute scarcity. When supply is constrained, that's when the property price is going to skyrocket. When I am evaluating a property, I ask myself, am I buying something that will become harder to replicate in the future or easier? So properties that become harder to replicate are often the ones that deliver the strongest long-term capital growth. So I'm just going to give you 2 bonus tips. The first bonus tip is that I like to buy Torrens Title properties only. Why? Because when you own a Torrens Title property, you don't have to pay that annoying strata fee. Okay, strata fees can eat up a lot of your profits. So avoid community title properties like units, apartments, townhouses. For me, I don't like those sort of properties, but that's just my opinion. But it's entirely up to you because I don't like to pay strata fees. They're just bloody annoying. So for me personally, I would recommend you to buy Torrens Title properties only, but that's entirely up to you. This is just my personal opinion. And the other tip is that I like to choose variable interest rates only. I would never pick a fixed interest rate. The reason is variable interest rates allow you to pay down your mortgage a lot faster. With fixed interest rates, they don't allow you to do that. So variable interest rates provide flexibility, offset accounts, and extra payments, whereas fixed interest rates can be useful when rates are historically low and when you need repayment certainty and when your budget is tight. But in my personal opinion, I do believe variable interest rates are far superior, but it's entirely up to you. If you're on a tight budget, then maybe a fixed interest rate may be right for you.
Okay, so the last and final tip I have for you guys today is to take advantage of the first home owner grant, and that's available across all Australian states and territories. But the amounts, property value caps, and specific eligibility criteria will vary significantly from state to state, so you need to double check that yourself. Generally, these grants only apply when buying or building a new or substantially renovated home, and it doesn't apply for established properties. So each state will have its own eligibility requirements, but generally speaking, you must be an Australian citizen or permanent resident or at least 18 years old. You and your spouse and partner must not have previously owned residential property in Australia. You must live in the home as your principal place of residence for a continuous period, usually 6 to 12 months, starting within the first year of ownership.
All right, so those are my 10 top tips for buying your first property here in Australia. I know it's getting a lot harder now to buy properties. It's still very possible in my opinion, but you just have to be a lot more disciplined and have to understand the game of real estate. All right, if you enjoyed this video, give this video a thumbs up, like, comment, share. I will catch you guys in the next video. See ya.